How exactly are we supposed to balance risks? How do you limit the risk in your portfolio? Now, we all learned back in 2008 that the way we'd been doing it was wrong. And in fact, there's an analogy with food. When you're looking for what's healthiest, what's least risky when you're eating, you need to look at the underlying nutrients in the food and balance those. It doesn't really matter exactly what the meat is that you're eating in itself, it's what's inside it, what's inside the rest of it. The same is true of asset allocation. Pre-crisis, everybody used to manage their assets using different asset classes, stocks, bonds, cash, etc. But what they've discovered during the crisis was that in fact, if the same risk affects an asset in the same way, there's really no point adding it to your portfolio. Here are some examples. This is how the S&P US stock index did compared to the exchange rate of the euro and the yen during the crisis. Those things should really have nothing in common with each other, but they ended up becoming almost perfectly correlated. You could go and play in the currency market, it wouldn't do anything to limit the risk you were already taking in equities. Here's another example, oil and the dollar. Oil went up hugely ahead of the Lehman debacle in 2008, and the dollar, absolutely in line with it, went down hugely. Those two markets are completely linked. Again, they lead each other. There's no saving, no reduction in risk by spreading between them. Now that carried everywhere. It was so pervasive that if you could even get something as bizarre as this. These are the stock exchanges of Budapest and Seoul in Korea. You can see those two countries have very little in common with each other, but they moved almost perfectly in line with each other. They were both classified as emerging markets. People invested in emerging markets as a block, and they moved together. Now, if we take a look at what's happening today, you can see that exactly the same problem exists, even if the oil price is now moving in the opposite direction. As you can see, oil is tumbling and the dollar is strengthening with it. Again, absolutely clear one-to-one relation, total correlation, therefore no diversification, no extra safety by spreading your risks. Or look at this, this is industrial metals prices compared to emerging markets foreign exchange. As metals prices go down, lots of emerging markets export metals, it damages their foreign exchange. No diversification there, remarkable correlation. Or if you want to take a really specific example, this is the copper price compared to the Peruvian stock exchange going back many years. Peru does indeed export a lot of copper, but what you see here is that they're basically treated as though they're exactly the same thing. So it's obvious we have to look at the nutrients, the underlying risk factors in our investments, not just the investments themselves. Many different people are coming up with new separate theories of different risks so that you can change the way in which you can allocate your money. Here is just one example. It comes from Willis Towers Watson. They look at the following risks. Equity, how much would your investment move with the broad equity market? Credit, if things tighten up, if there is a credit squeeze, a credit crunch like there was in 2008, would you be affected? Inflation, some assets do well during inflation, like maybe gold, others do terribly, like maybe bonds. Illiquidity, if the supply of money dries up, if people don't want to trade, would it be a disaster for your investment, or would it help? It's a broad common risk. Then they also look at whether you're exposing yourself to the skill of the manager, whether this is something that requires people to be clever to make the right bets on, or whether it's simpler than that. That is one way of doing it. There are many others, but what we all now grasp, what is the future of investing, is to look at the nutrients, not the food, to look at the risk factors, not the asset class.